Hello everyone, I hope your day is starting off just as fantastic as it possibly can. I think the year's major story broke Friday afternoon, one of the most important stories of the year, and it probably won't get very much coverage because it involves numbers, graphs, and charts. Other than perhaps some inflammatory rhetoric that you'll hear from some politicians and some negative slogans that you might hear about the story. But I thought I'd do a video about it, and it's the type of story that will be underreported, but the repercussions could affect everyone's lives, your life, more than anything else over the next decade, let's say. And it's very negative news for the United States and a concern for Canada, although there's reason for Canadians to be cautiously optimistic. Let's read the headline first, and then I will go through some of the charts and graphs like the one you see behind me, but I'll try not to make the video boring. I'll try and make it informative for you. Bloomberg reports the U.S. was stripped of its last top credit rating by Moody's rating, reflecting deepening concern that the ballooning debt and deficits will damage America's standing as the preeminent destination for global capital and increase the government's borrowing costs. The actual statement that Moody's released was, while we recognize the U.S.'s significant economic and financial strengths, we believe these no longer fully counterbalance the decline in fiscal metrics. On Friday, lawmakers in Washington continue to work towards a massive tax and spending bill that's expected to add trillions to the federal debt over the coming years. The move comes at a time when the federal budget deficit for the U.S. is running near $2 trillion a year, or more than 6% of gross domestic product. The rating company expects, quote, federal deficits to widen, reaching nearly 9% of GDP by 2035, up from 6.4% in 2024, driven mainly by increased interest payments on debt, rising entitlement spending, and relatively low revenue generation. Moody's identified higher Treasury yields as a factor hurting U.S. fiscal sustainability. Yields between 4 and 5% are near levels that prevailed before 2007 and the financial crisis. So deficit numbers as a percentage of GDP and Treasury yields, there's lots of numbers there. I'm going to try and explain them to you in an easy to understand way. And I'm going to contrast the situation in the United States with that in Canada. But the main story here is that Moody's, an independent rating agency, has downgraded the United States credit rating. How does that compare to other countries' credit ratings? Here's a list of all the countries in the world ranked by their credit rating score. And surprise, 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 number one, tied with a few other countries, is Canada, with a AAA credit rating across the board. Australia, Canada, Denmark, Germany, Liechtenstein, Luxembourg, Netherlands, Switzerland, Norway, and Sweden all have across the board AAA credit ratings. The United States has a AA plus from S&P and now has been downgraded by Moody's. You see the little arrow pointing down there. What it means is that these rating agencies believe that there's a higher risk that the United States will not be able to pay its debts. And that reflects itself on the yield of the U.S. 10-year Treasury bond, which is the graph behind me. And you can see on this graph that since the year 2020, where that bond had a yield of less than 1%, has steadily been increasing and is now yielding 4.5%. That's a huge change. And why would the yield of a bond go up? Well, there's a lot of different factors, but in particular for the U.S. 10-year Treasury bond, the biggest factor is that investors now demand a higher rate of return to make that investment because they feel that that investment is riskier. So why has the yield been going up since 2020? Let's look at some numbers that hopefully explain this. So we're on the Trading Economics website, which has lots of different economic data that you can look at. And the particular graph that we're looking at right now is easy to understand. This is the United States GDP, the gross domestic product, the value of all goods and services generated by the U.S. economy. And you can see that that GDP has been pretty steadily increasing, and I've displayed from 2013 till present. And right now, the United States economy, you can look on the graph here, generates $28 trillion of GDP per year. That's the world's biggest economy. Now that graph we just looked at looks very positive, a growing economy. But look at this graph, the United States federal debt to GDP ratio. Oh boy, now we have two numbers and they're divided. It's getting complicated. What does this mean? Well, this is a ratio between the United States debt number and the United States GDP number. And you can see on the graph here that between 2013 all the way to 2019, that ratio was about 100 or 100%, meaning that in the United States, the debt has been growing at about the same rate as the economy, virtually 1-to-1. So if we go back to the previous graph here of US GDP that we just looked at and just pick any year like 2016, the US GDP was about $18.8 trillion. Well, the US debt also rose to about $18.8 trillion. And that was the case basically, what did we say, between 2013 all the way to about 2019. And now we're back to the graph of US federal debt to GDP ratio. And you'll see that something happened in 2020 and 2021 and 2022, and it's been fairly steady now. That debt to GDP ratio has jumped to the 120, 122%, and the most recent year, 2024, 124%. So what it means now is that the United States debt is higher than the United States GDP. And that ratio has been maintained over the past 5 years. That's a bad situation. Now, let me contrast this with Canada. This is Canada's GDP displayed over time. And you can see that in 2013, the total value of our economy was about $1.8 trillion. It actually dipped down in 2025, the last year of Stephen Harper being the prime minister, to about $1.5 trillion, and then started increasing. And now the last year, 2024, the Canadian economy was worth $2.1 trillion. Our debt to GDP graph looks similar to the US, but our numbers are slightly better. Starting in 2013 through 2019, our debt to percentage of GDP hovered around 90%, meaning our debt was lower than our GDP, then spiked up in 2020, and then started to come down a little bit. And it looked like by 2022, our debt as a percentage of GDP would fall below 100 again, but it didn't. It's ticking up again, but nowhere near as bad as the United States. Right now, in 2024, our debt as a percentage of GDP is about 110%. Our debt and our GDP are about even. So why would Moody's downgrade the United States but not Canada based on those numbers? Because to an untrained eye, those numbers look pretty similar. The graphs look similar, but the numbers are substantially different. And this graph maybe explains another layer of the story. This is a graph displaying the United States federal government budget as a percentage of GDP yearly. You can see that all of these values on this are all negative, meaning that every year since 2013, the US ran a budget deficit. And for each year, this displays what percent of the GDP was that deficit. In 2013, it was 4% of GDP, and it hovered 2.5%, 3%, 3.4, 4.6. 2020 was a disaster year for all countries. Remember, that's when all the shutdowns from the pandemic happened, and the US budget deficit was almost 15% of GDP, and it hasn't really recovered that well. 2021 was 12% of GDP, the US budget deficit. At 5%, 6%, and in 2024, the US budget deficit was 6% of GDP. Now, let me try and explain what that means. Okay, 6%, is that a big deal? What does that mean? That means, in particular for 2024, the United States budget deficit, and remember, governments can run a surplus or a deficit, right? They collect money and they spend money. So this means the United States spent more money than it collected, and the amount that they spent more of, the deficit, is equal to 6% of the GDP. So just to keep the debt to GDP ratio the same, the GDP has to grow 6% to keep that ratio the same. So if you're going to run a deficit that's 6% of GDP, your GDP has to rise by 6% to keep the debt to GDP ratio the same. If you consistently run deficits that are a higher percentage of your GDP than the GDP growth, you're going more and more and more into debt. And you run the risk of it running away from you and never being able to catch up. Let's look at the same numbers for Canada. And this is a wildly different story, okay? Now, all the budget numbers in Canada, like the US, have been negative every year, but the numbers are very different. Starting in 2013, our deficit represented less than 0.5% of GDP. And that value kind of hung in there till about 2018. our deficit was 0.6% of GDP. Now, we had a huge spike in 2020, the year of the pandemic, just like the United States, and it was just a disaster year, our budget deficit representing about 15% of our GDP. A terrible number, but we recovered very quickly. In 2021, our budget deficit was 3.6% of GDP, 1.3% in 2022, 1.4%, about 1.4% in 2024. These numbers are much more sustainable because you can do the same math with Canada. If you're going to run a budget deficit that's 1.3% of GDP, you need your economy to grow at least 1.35% just to keep the debt to GDP ratio the same. If your economy can grow more than 1.3%, then your debt to GDP ratio is actually decreasing, which is a good thing. So these kind of numbers should give Canadians cautious optimism that the path forward for us is much easier than in the United States because we can grow our GDP by more than 1.35% a year. We have the ability to do that much easier than the Americans growing their economy 6% per year. And remember that Canada is a resource-based economy. We do a lot of exporting of raw materials. And it's not that hard to increase that by trading with more trade partners around the world. So it shouldn't be difficult for Canada to grow the economy faster than our debt is increasing and decrease that ratio. Whereas in the United States, where they've been looking at over the past 10 years, and this crosses the boundaries of different administrations, right? I know that you'll hear politicians just spouting rhetoric and shouting slogans and blaming each other about the mess they're in. But over the past 10 years, the United States has consistently had debt as a percentage of GDP, numbers that are unsustainable, like 4.6%, 3.8, 4.1, and more recently in the 6% range. The United States economy does not grow. The GDP does not increase by 6% yearly. It would be considered a very good year if the United States economy grew by 2 or 2.5 or 3%. And the United States economy is much more of a broad-based economy. They don't simply provide the world with raw materials. A much more sophisticated economy, overall a better and stronger economy. Their problem is that they're increasing their debt faster than the economy is growing. And that's why their credit rating has been downgraded. It could snowball into a very difficult situation for the United States. Investors that buy US bonds, that lend the US money, are going to start demanding higher yields, a higher rate of return for those investments because they view them as riskier. And it'll cost the US more to borrow money. And they borrow money like there's no tomorrow. They borrow more money than the value of their economy. And if that starts to snowball out of control, it could put the US in a very precarious situation economically. There's a reason that the United States is trying to use tariffs as the centerpiece of their economic policy. They want to generate revenue from imports that are coming from abroad, taking the money in the form of taxes from Americans. And they're gambling on the fact that these tariffs will incentivize companies to come to the United States and produce and build products in the United States, which would increase the US GDP. But of course, every plan is much more complicated than it appears at first, and there could be many unintended consequences. For example, if you approach this policy by insulting and berating and threatening and starting a hostile trade war with everyone on Earth, the repercussions may not be exactly what you expect. For example, your tourism industry could collapse. Perhaps, instead of just being able to collect these tariffs from imports, maybe the total amount of imports will drop significantly as countries form other trading alliances with each other. And those two perhapses could result in the United States GDP actually shrinking, maybe going into recession or not growing as fast. So now the United States could find itself in a position where their debt is increasing at 6% of the value of the GDP. And for the next year, the GDP may not increase at all, which means their debt to GDP ratio will have a huge spike. And that may scare investors even more, and they may demand an even higher yield on their purchase of US bonds as they lend money to the United States. And an even higher bond yield would mean that the debt that the United States is servicing, the interest payments they have to make on any new debt they issue, will be even higher, and the snowball keeps rolling down the mountain. So going back to this graph now of Canada's GDP, what does Canada have to do going forward? And I mentioned that I'm cautiously optimistic that Canada is in nowhere near as bad a circumstance as the United States. You look at this GDP graph, and we have to get this GDP number starting to go up consistently. Canada needs to grow its economy. That's absolutely essential for us in the next decade. And you can think of it this way: a rising GDP floats all ships. And let me explain that a little bit, because discussions like this are very complicated and economics is very complicated. And it was a lot of work to make this video, doing all the research and finding all the numbers. It would be much easier for me to make a video and get a lot more views by just saying this: Canada's broken, our budget is a disaster, our debt is out of control, our GDP to debt ratio is ridiculous, things are falling apart, and by the way, there's violence and chaos everywhere. We should cut all spending, we should stop giving money to dictators, we should axe everything. We need to fix the budget, fix the debt, build a home, stop the crime, and bring it home. Now, that's easy. I could do a video like that and get a hell of a lot more views and maybe even become prime minister. But it's more complicated than that. Actually trying to build a solid, growing economy with a manageable deficit and debt is complicated. And I know that our new Prime Minister, Mark Carney, has said that the economy will be his number one focus going forward. So if we go back to this graph of the Canadian government budget, and you can see we've been running a deficit every year for the past 10 years. In fact, we've run deficits almost the entire existence of Canada, except for a few years. But how do we get our deficit as a percentage of GDP down to these manageable levels like they were in 2013, 14, 15, 16, as opposed to these higher numbers here? Now, it's easier to do by increasing your GDP than by cutting spending. And the reason is because your GDP of your country is kind of like a big ship, and it tends to have momentum. When you get to a certain size, a certain GDP, if circumstances don't change and things kind of stay the same and the government doesn't do anything dumb, it kind of stays there and wants to go up as exports increase, or oil drilling increases, or manufacturing increases, or the production of aluminum increases. And if you can make your GDP for your country go up 2 or 3%, 2 or 3% of $2 trillion, which is our GDP, is a big number. And that number will be generated by all the businesses and all the activity of the whole nation. Now, decreasing spending to get your debt to GDP level to go down is a different beast. If you go to the Government of Canada's website here, where they have a table of the composition and estimates of expenditures, our budget over the past number of years, you look at the main categories here and you look at the column on the right there, 2024 to 2025 main estimates, total transfer payments, $282 billion, transfers to the provinces, many of them that really can't be reduced, like the biggest one there is health care transfers to all the provinces, operating and capital budget, $119 billion, public debt, $46 billion. The total government budget for Canada in 1 year is $449 billion, less than $500 billion on a $2 trillion economy. So you just compare those numbers. A $2 trillion economy growing by 2% adds $50 billion to the GDP. If you want to cut $50 billion from spending, you have to cut government spending by 10%, not 2%. You're starting with a smaller number, and probably 75% of the government spending is stuff that nobody wants to cut, like healthcare, and stuff you cannot cut, like public debt, interest we're paying on money we've already borrowed. You can't cut those things. So out of this $449 billion budget, there might be $100 billion worth of stuff that you could try and cut. So if you want to cut $50 billion from that $100 billion, that's a 50% cut. You would be making massive, massive cuts, very disruptive cuts, to achieve the same amount as, say, the GDP going up 2%. It's always been easier to sustain your economy by growing your GDP than cutting your spending. And that's what the United States has been trying to do. And they've been successful at growing their GDP, but they've been spending so much as a percentage of their GDP that they now got their credit rating downgraded. So let me just speak about Canada here, what we should do going forward, and what hopefully our Prime Minister will focus on and do. And the main points are these. Yes, you should consider some targeted spending cuts. Unnecessary spending should be cut. But don't expect that you're going to cut your way into prosperity. The number one goal should be getting this GDP up. And you notice that in the past 3 years, our GDP has been flat. We need that number to start going up. That would be the best thing for the Canadian economy. So number one, concentrate on increasing this GDP. Number two, do not increase spending unnecessarily now. That would be a bad idea. Number three, make some cuts, some targeted cuts on unnecessary things, and do it in a well-balanced, well-thought-out, mature way. You can't do this just by slinging some slogans, okay? You can't just say fix the debt, balance the budget, stop the crime, everything will be great. It's complicated. But the main takeaway for this video, and if you're still watching it, I appreciate it, because I know there was a lot of numbers and a lot of graphs, and sometimes that bores people and they'd rather just hear a slogan. But this stuff's complicated. And the main takeaway here is that the United States is in a precarious situation. They're in a very tough situation. They're going to have to do something about it. And I wish them luck. But Canada is not necessarily in that situation. I have a cautious optimism that we're in a much better situation. Now, another complicating factor is if the United States goes down, if their economy starts to sputter and things starts to snowball, they're our biggest trading partner and our biggest customer, and they'll take everyone with them. So we have to hope that they fix their economic house. And I have to say, attacking and berating and insulting everyone on earth, I'm speaking to the Americans here, is not going to make it easier for you. I could just guess off the top of my head, and I will be correct in saying that the loss in GDP growth in the United States just from the decrease in tourism from visitors around the world could offset a large portion of some of the tariff revenue you're going to get from some of your closest neighbors. These things are complicated and there's a lot of unintended consequences from actions that people take. So looking forward, I do feel some cautious optimism that we have a leader that understands all this economic stuff. He really does understand it. And hopefully he guides Canada forward and we start seeing some of these numbers turn positive for us. The numbers are not so bad economically for Canada, and I think they can improve very quickly if we unleash the total potential of our economy. So let's wish Mark Carney luck, and I'm glad you guys hung in there and watched the whole video. Subscribe to the channel if you enjoyed the content. These videos take me a long time, and I do a lot of research so that I'm not just spouting ridiculous numbers that make no sense or just quoting politicians and political slogans. I try and put thought and search out the facts for you guys. Hopefully you're finding them worthwhile. And if you are, I'd appreciate it if you subscribe. Leave some comments, and I'll catch you guys on the next one.